I bet you I'm one of the only people on this show that's actually been to the New York Fed gold vault. My Morgan Stanley guy says to me, all your property is dead money. I said, Sanj, I don't want to, I like dead money because I'm living in the property. But see, everybody says if we have $1 million of the gold sitting in the vaults, that's dead money. We need to monetize that gold. So we got to loan it out. And then the person that buys that says, I can't just sit here with this gold. I got to loan this gold out. I got to get some return on my investment. Basis points. Everybody does this.
A potential gold revaluation presents a unique, non-default pathway for managing the United States' surging national debt. The discussion extends beyond simple market pricing, with central banks showing renewed interest in physical gold and a global trend toward repatriating tangible assets. EBTucker explains that if gold reaches $4,000 per ounce, U.S. reserves would be worth $27 trillion, about half the U.S. stock market's valuation. He highlights that stocks are a uniquely American asset, contrasting them with the London Stock Exchange, which struggles to retain major companies. It took gold a decade to appreciate from $2,000 to $3,000, and according to our charts, the market is behaving similarly to 2011, a peak that lasted a decade. Thus, moving from $3,000 to $4,000 might take another decade. If so, the interest payments on an equivalent amount of debt would roughly wipe out the price gain. Reflecting on his personal experience, Tucker recalls visiting the New York Fed Gold Vault in 2001. He notes that institutional investors avoid physical gold, preferring futures and contracts since physical metal is lately seen as dead money that doesn't generate returns. However, recent developments have raised concerns over the accuracy and transparency of these reserves. Speculation about potential shortages or overstatements in U.S. gold reserves could significantly impact financial markets, inflation expectations, and investor sentiment. However, Tucker emphasizes J.P. Morgan's near-silver crisis due to the Wall Street silver movement. He explains that institutions avoid holding physical metals, preferring to lease gold and create complex financial instruments. Recently, gold deliveries on the COMEX have reached record levels, a clear indicator of the explosion in demand for physical gold. This phenomenon could create a snowball effect, prompting other major institutions and central banks to step up their delivery demands, putting further pressure on the system as a whole. Regarding international gold flows, Tucker claims London banks avoid gold storage costs by leveraging geopolitical pressure on gold-producing nations. Now, we present the clips of EBTucker's insights from their recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
A lot of times these things are dialectic. I mean, there's not, it's not like I'm coming to you from the future and I'm here to tell you, but you start doing this math and you're like, okay, well, what's going to happen that's going to send gold? Like, let's say it's going to go to 4,000, that's like a 35% increase. That means that you'd have $27 trillion of the gold. So what's the stock market going to be worth? If the stock market's worth, 60 trillion, then that means that all the gold is worth like half the US stock market. I mean, stocks are a very United States thing, right? I mean, that's why like the London Stock Exchange is pretty pitiful, right? I mean, Glencore is talking about leaving the London Stock. What are you guys going to do if Glencore leaves? I mean, like the listing fees that they pay, right? I mean, it's like, imagine nobody's listed there, okay? But maybe some African uranium company, but that doesn't really count. So the thing is that it's a very American thing. So when I say it's a $60 trillion, stock market, I'm talking about the American stock market, which is the Americans always think other stocks around the world should do this and that, but it's like they've never traveled before. It's not really like a Bolivian thing to do, to list your company on the local exchange, in La Paz or whatever. It's like it's not going to happen. So my point is that what's going to happen to make gold go higher? And everybody says, well, it's not in Fort Knox. Okay, well, look, I've been around this for a long time. I'm one of the only people, I bet you I'm one of the only people on this show that's actually been to the New York Fed Gold Vault. I went there in finance school in 2001, in May of 2001. I got to tour the vault. It was unbelievable. I mean, it was one of my first times I ever saw gold in that quantity, like those huge bars. And what they were doing is they were moving them around on pallets. They had these special aluminum shoes to protect if they dropped it. The gold obviously is not like so easily there. And the reason why is because nobody wants to buy this gold bar and spend the money. Now, I like to have this gold bar because I'm in a place in my life where like it makes a lot of sense to me to not have a mortgage on any of my properties and to have a gold bar because I don't really want to go back to work and struggle and like I don't want to do that again. I did that. There's a lot of people that are unpleasant that I had to work with and I don't even want to talk to those people. So I'm in a place where I'm happy to own something like a home and I own my office and it's not as nice as you would think, right? It's not like I've got this palatial home or something. I have like a really cool, all my properties are super, super cool, but they're not big. And people need to understand that that's my philosophy. Now, all my friends that run funds, I have a lot of friends that run major funds. They absolutely will not buy gold. They'll buy futures. They'll buy options on futures. They'll buy unallocated gold or allocated gold or some sort of synthetic exposure to gold because it's a trade for them. Everybody is like this. Everybody is like this. JP Morgan almost had a major silver problem thanks to the Wall Street silver guys. Do you know that this was actually almost a real problem? I'm not sure. I know the Wall Street silver guys. I'm not sure if they realize they almost caused a major problem. Why is that? Well, JP Morgan says, well, we had the metal, we just couldn't get it. Right. Because nobody wants to own the metal because it's wasted money. It's dead money. There's a concept called dead money where the money's just sitting there. Like my Morgan Stanley guy says to me, all your property is dead money. I said, Sanj, I don't want to, I like dead money because I'm living in the property. I don't need to borrow against the property so that you can buy more tech stocks or something. I'll give you some money to buy some tech stocks, right? Like tech is the future. I'll give you some money to do that. But I don't need my house to collateralize a trade in the tech market. But see, everybody says if we have $1 million of the gold sitting in the vaults, that's dead money. We need to monetize that gold. So we got to loan it out. And then the person that buys that says, I can't just sit here with this gold. I got to loan this gold out. I got to get some return on my investment. Basis points. Everybody does this, okay? And so then what happens is that the London guys say, London people are very cheap, by the way, so they don't want to pay for anything, not even like storage for their gold. Well, we got to get some more gold because we got all these complicated loans going on. So we got to get more gold. Okay, what are we going to do? Well, we got to go to the countries that produce the gold, and we got to get the United States because we're too cheap to have like a real, presence. We got to get the U.S. to tell them like Argentina. You got a choice here, buddy. You either want the warheads pointing at you or pointing out, defending you. And if you want that, you got to send your gold to London. That's what they did. You saw this, right? They send like tons and tons of gold to London. All these countries send the gold to New York, send it to London, and then they can't get it back. Why can't they get it back? Because it's the denominator. Remember in math, you have the numerator, the denominator. It's the denominator of this gigantic gold daisy chain, okay? The gold is there, but what happens is it's contractually involved in so many things.
Looking at major fundamentals, EBTucker argues that gold's price movements over the past few years were due to a well-managed financialized market rather than external factors like tariffs. He explains that large-scale futures trading was used to control price volatility, but recent declines in futures volume indicate a shift in market dynamics. Strength in gold earlier this month is linked to increased safe haven demand, increasing expectations of accelerated Federal Reserve interest rate cuts, and growing inflows into gold-backed exchange-traded funds. Since December, over 600 tons of gold have been transferred to New York City vaults, according to the World Gold Council. Gold has not been a direct target of tariffs, but market reactions to trade uncertainty have driven a significant shift in trading behavior and impacted the gold price. The movement of gold from London to the U.S., rising COMEX premiums, and concerns over availability were largely the result of risk management decisions rather than true supply issues. Now, as more people request delivery, several-month delays reveal the structural weaknesses in the system, reinforcing his view that gold's price will continue rising over time, albeit in a controlled manner. Let's get back to the interview.
I think probably what happened is the reason why gold was behaving the way it was the last few years is because of an extremely well-managed financialized market. What that means is that if you were to watch when the gold price got hit every now and then, you would have like half a year of mine supply traded in the futures market in one session. But that's gone down. So if you notice, like what's been happening recently is on a down day, the volume on the futures is lower. It's a lot lower. And what that means is that the trade is not as liquid. And I think what happened was that, because see, if you want me to fix the price for you of, say, cotton, I can fix the price of cotton for you. And the way I would do it is I would manage that price using futures. Because if you gave me like several $billion of futures credit with an exchange, right? Like say I'm on RJ O'Brien's platform and I'm like, I'm going to control the price of cotton. It's pretty easy. If it gets too high, I sell into the market. And then it goes back down, I buy that back. It's very easy to do. And I'm not really necessarily doing it for some nefarious reason, because the gold price is up like almost 1,000% since the year 2000. But the problem is we don't want it to go up too much too soon. Okay, we want it to like slowly go up. And so we're going to manage it. We're going to put a collar on it. And so I think the reason why you saw this gold shifting is because there's actually not that much gold underlying the amount of gold being traded. And the reason is because what I told you earlier, it's like the guys that I'm friends with socially, they absolutely will not buy any gold bars because they don't want to tie the money up, because they get paid on performance. And if they just leave the gold sitting there and it only goes up 40% in the last year, it's not enough performance for them. They need more. So they need multiple Ferraris. So the thing is that I think what happened is nothing to do with tariffs, because the tariffs actually there actually have not really been that many tariffs. It's just been like the threat of tariffs, right? And so you're like, okay, what is the threat of the tariff going to do to the gold bar? Because it's not even the gold bar, like whose gold bar is it? Okay. Like there's not going to be, if there's a tariff put on Mexico for the price of car bumpers, it's nothing to do with gold bars. Like somebody's gold bar is in London and it's multi-collateralized in a big trade. And it's like, that's the problem. The problem is not, import tariffs. You're not going to import tariff gold, because whose gold is it? Like I've been to Argor, Heraeus, and all these refiners in Switzerland. There's always like gold being melted and changed to like different fineness levels to evade tariffs. Like I've seen this happen in person, in real life. Like it's being changed from 3 nines to 4 nines because there's always these like loopholes. There's nothing to do with tariffs. This is a headline. So people, but even my friends in the business, they're like, yes, the tariffs are doing it. I'm like, it's not the tariffs. It's not the tariffs. The problem is that the gold is multi-collateralized. And there's a shift going on. There's a change going on. Like if you ask for your gold bar, it takes like 3 months to get it. That's a problem. That's nothing to do with tariffs. It's a problem. It's like you don't have the gold. But you can have the gold, but it's like, oh yeah, but you don't want to spend the money. You see what I mean? It's like this on a high level. But what you got to do is you got to be like, look, the fact of the matter is that gold is going to slowly go up over time, and they're going to have to keep the price under control. Their price is not going to go to $10,000 next week. It's not going to happen, okay? It's going to go up, because if it starts to go up too much, they're going to smack that thing. Because if it starts to go up too much, you're going to freak out. That's what's going to happen. Everybody's going to freak out if they see that. And so don't be fooled by these headlines. The price is going up because the money supply is going up, the asset prices are going up, and people are having a shift in narrative right now. And they said, give me a few of those gold bars. Well, we have them. It's just going to take us a few months to get them. But if it's going to take you a few months, it's like the company that tried to swindle me out of my stock this morning. Oh yeah, they're like, definitely it's worth, this price, but we're only going to pay you 90% less. It's like, okay, that's the price then, right? You see how it goes? Like, yeah, we have your gold, but it's going to take a few months to get it. Don't be fooled by that.
The speculation around U.S. gold reserves highlights the need for investors to remain vigilant about macroeconomic risks. While past market trends suggest gold is a strong hedge against uncertainty, advisors must also consider portfolio diversification and inflation hedging strategies. As the U.S. national debt rises, could a significant gold revaluation become a viable solution to help stabilize the financial system? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.